Today on Real Estate Backstage, mortgage rates have dropped to their lowest level of the year after a weak jobs report. Mr. Cooper shareholders vote to approve the Rocket acquisition, and the DOJ launches a criminal investigation into Fed Governor Lisa Cook. Before we jump in, if you're watching on YouTube or listening on Apple Podcasts or Spotify, make sure to subscribe to the show that way you don't miss any future episodes. And if you're looking for the show notes with links to all the articles that we're going to reference today, you can find that at realestatebackstage.com/episode 38. Now, if this is your first time watching or listening, I'm your host, Michael Smith. I'm the CEO here at Bluefield. We're a 4-time Inc. 5000 company headquartered here in Greenville, South Carolina, and we provide real estate brokerage, property management, and insurance services. So we're going to jump in with mortgage rates, everyone's favorite topic. This is according to Housing Wire. Quote, mortgage rates decreased slightly on Wednesday morning to a year-to-date low of 6.49% after the jobs openings data came in below expectations. The key takeaway from the BLS report is that we now have more unemployed workers than job openings. This is significant because the Federal Reserve has traditionally valued job openings data and has emphasized that there have always been more job openings than unemployed workers in the past. On this news, the 10-year yield fell a few basis points, and this is one of 4 labor reports we will get this week. Now, for those of you watching on YouTube, I've got a graph to put up on the screen here. This is courtesy of Housing Wire. This goes all the way back to January of 2000, and it shows the number of job openings. And you can see that as of right now, we're at about the lowest level that we've been since the COVID era. All right, jumping back into the article. While today's job openings report wasn't terrible, it was soft enough to lower bond yields. This will be the last job openings report before the next Fed meeting, and the Fed has emphasized this data point significantly over the years. The labor market is not showing signs of breaking down, but it lacks a solid foundation, as manufacturing and residential jobs are currently being lost. Without the influx of AI-driven investment into the economy, the labor data would likely be in a worse state. We will see what the upcoming reports reveal, but beating the 3-month average of 35,000 job growth this Friday shouldn't be too difficult, unquote. Well, Logan Mohtashami there, the author of that article at Housing Wire, said it shouldn't be too difficult, but apparently it was difficult because we did get the jobs report for August, and the numbers, believe it or not, were significantly lower than expected. Now, this is according to Connect CRE. Quote, U.S. non-farm payrolls rose by only 22,000 in August, falling well short of the 75,000 expected and down from 73,000 in July, according to the Bureau of Labor Statistics. The unemployment rate ticked up to 4.3%, in line with forecasts, while prior month's job growth was revised down by a combined 21,000, including a rare decline of minus 13,000 in June. It's the first time we've had a negative reading in quite some time. Wage pressures moderated, with average hourly earnings up 0.3% month over month, matching expectations, but slower than July. On a year-over-year basis, earnings eased to 3.7% from 3.9%. Labor force participation improved slightly to 62.3%, suggesting more workers are returning to the job market despite weaker hiring demand. The report strengthens the cause for the Federal Reserve to resume rate cuts at its September meeting. Fed funds futures now imply sequential 25 basis point cuts in both September and October, rather than a larger move in September. I think that's probably pretty likely. I still think we're going to see a 25 basis point cut in September, and as long as things continue going the way they are, there's a pretty good chance we're going to see another quarter point cut in October as well. Chair Jay Powell has described the labor market as caught in a curious balance where hiring demand has softened while immigration restrictions have constrained the supply of available workers, unquote. So the labor market continues to show signs of weakness. We had additional downward revisions in prior month's data. We had a very weak reading in the month of August, and the unemployment rate ticked up to 4.3%. Now, that's not a huge movement, but it is significant because the unemployment rate has been bouncing up and down between 4.1 and 4.2% for basically a year now. So we may have kind of broken through that threshold, and we might continue to see the unemployment rate creep up from here. Definitely something to keep an eye on because this is what the Fed is keeping an eye on. I think the Fed is now prioritizing the labor market over the inflation data. I think they really want to be a little bit more proactive. Historically, over the past year or so, they've really taken a wait-and-see approach, being very hesitant to cut rates because of the risks posed from the tariffs. And we have been seeing inflation numbers start to creep back up, but I think the Fed is starting to realize they need to be a little bit more proactive with starting to ease policy because there are some signs of pretty significant weakness in the labor market, and they don't want to send us into a recession. All right, shifting gears, close to 1/3 of home purchases in the first half of 2025 were from investors. This is according to RIS Media. Quote, institutional investors' market share of home purchases reached a new peak. The Totality report states that in January of 2025, the proportion of homes purchased by institutional investors reached its highest level in at least 6 years, at 31.9%. This has ticked down slightly to 29% as of June 2025, but that share is still high compared to previous years. For example, in June of 2024, only 25% of home purchases were made by investors. These investors' lowest market share in the past 6 years was in April of 2020 at 14.5% of purchases. That, of course, was right after the world kind of shut down from COVID. A lot of investors wanted to hold on to their cash, and they were being very, very risk averse at that time. Since then, the share of investor purchases has been generally ticking up, albeit with a few dips along the way. However, the report noted that investors taking up a larger market share is largely due to a decline in owner-occupied transactions. In fact, the raw purchase volume of homes by institutional investors has shrunk. During the first half of 2025, investors purchased an average of 85,000 properties, largely unchanged from the 84,000 average during the first half of 2024. In 2022, however, the monthly purchase average was 120,000 homes, unquote. So the share of purchases being made by investors, specifically institutional investors, which typically is defined by entities that have more than 100 properties under management, that is really at the largest percentage that it's been in quite some time. But that's not because these institutional investors are just racing to gobble up more inventory. It's because the number of owner-occupied transactions has shrunk and the number of investor purchases has remained relatively stable, which is why that percentage, the market share percentage, is higher. All right, so in a similar vein, America's homeowner population has declined for the first time since 2016. This is according to Inman. Quote, for the first time since 2016, America's homeowner population has ticked downward, while the number of renter households has seen some of its largest growth as consumers face ongoing homeownership affordability challenges. During the second quarter of 2025, the number of homeowner households in the U.S. dipped by 0.1% year over year to about 86.2 million households, according to a new Redfin data analysis of U.S. Census Bureau data. The decline is slight but significant, since it's the first such decline in nearly a decade. Meanwhile, the number of renter households grew by 2.6% to roughly 46.4 million households. America's homeowner population is no longer growing because rising home prices, high mortgage rates, and economic uncertainty have made it increasingly difficult to own a home. Chen Zhao, Redfin's head of economics research, said in the company's study. People are also getting married and starting families later, which means they're buying homes later, another factor that may be at play, unquote. So I think this demographic and cultural shift that we've been seeing in our country is definitely having an impact here. It's not just the affordability issues of home prices are up, interest rates are up, things like that. Just culturally, people tend to be delaying marriage, delaying having children. So we're seeing a delay in household formation. People are living at home with their parents for longer than they did in prior generations. And you could say, that's a chicken and the egg issue. That household formation delay is happening because of the economic issues. You could make the case that people are waiting to get married, waiting to have kids because of the fact that home prices are high, interest rates are high. I don't know if I completely buy that. But this is just a cultural shift, a demographic shift that we're seeing in our country where household formation on average is taking place later in life, which of course is going to have some impact on the homeownership rate. All right, shifting gears, Nikia Wright, the new CEO at NAR, said that arrogance led to many of the problems that we saw at the trade association. This is according to RIS Media. Quote, in the high-profile discussion covering the evolution of NAR at RIS Media's 37th annual CEO and Leadership Exchange, Wright told the audience of more than 400 real estate leaders that internal NAR, through its arrogance, was not necessarily educating the leadership team on what they needed to know. As NAR seeks to implement a turnaround from multiple years of legal setbacks and leadership turnover, Wright has been tasked with winning back the trust of 1.48 million members. Wright began the discussion by recounting her experiences as a young person attending Berkshire Hathaway shareholder meetings with an uncle. She shared her favorite Warren Buffett lesson. If they lost money for the firm, we would be understanding and forgiving, but if they lost a shred of reputation, we would be ruthless. That's actually one of my favorite Buffettisms. Wright related that to her approach as she works to reshape NAR. In her conversation with Featherston, Wright acknowledged that NAR has experienced a large loss of trust and reputation, emphasizing that she and the organization are aware of this. We understand the challenges that are in the industry post-settlement. We understand the relationships that were ruptured, and we're trying to sort of bring all those together and then show them who we can be as we go forward, she said. By no means has it been easy, but anything that is easy is not worth doing. I do believe the current storm is coming to an end, she continued, and emphasized the continued growth is the key to a strong, prosperous future. Wright said that she and the leadership team are going around the country, meeting people where they are, and helping to understand what went wrong in the past, and trying to figure out what we can do to help chart a more meaningful and better future. A substantive move made to work toward this future and to help reduce the risk of further litigation was the elevation of Jonathan Wachlowski as General Counsel and SVP of Legal. Wachlowski previously worked on the advocacy side, and Wright said he is now part of the weekly leadership team meetings, ensuring NAR is not repeating mistakes of the past. Of Wachlowski, Wright said that he's got the mind of understanding who we are on the market. He's got the reps of having been a very seasoned professional. He understands a political landscape and also understands exactly what went wrong with regards to how we did not effectively manage the communications as it relates to the legal landscape. I think that's an understatement. According to Wright, Wachlowski advises effectively on what is winnable, what is negotiable, and where the organization's blind spots are, something she emphasized is needed. Wright also noted that public perception of NAR has not just deteriorated within the industry, but on a wider scale, explaining that mainstream media has spread misinformation, leading to distrust from consumers toward real estate professionals, unquote. So Wright certainly has her work cut out for her. I think in general, most real estate agents who are realtors, members of the National Association of Realtors, do not have a very positive view of the trade association. A lot of agents are still very upset about the settlement, how that was handled. A lot of people feel like NAR didn't fight hard enough, that they should have gone through with the appeals process, they shouldn't have settled, or they don't like what was in the settlement. A lot of negativity still being discussed, even a year later after the new NAR rules went into effect. I think a lot of that came from just the communication issues in general, along with all of the other issues that NAR has had over the year. We've got the scandals of the alleged sexual harassment that NAR has dealt with. There's that expose broken by the New York Times about how these people were being paid and all the benefits they were receiving. Even the volunteers were receiving incredibly high salaries. Just this culture of spending and lack of really fiduciary ownership, stewardship of NAR's finances. So there's been a lot of scandals, a lot of issues with NAR that we've covered on the show over the past year. So I can certainly understand why people are frustrated with NAR. However, I think that Nikia Wright so far seems to be doing an admirable job. Like I said, she certainly has her work cut out for her. We'll continue to cover any improvements that NAR makes, but it seems like they're at least trying and moving in the right direction. Now, speaking of NAR and the problems that they have, we of course have to talk about the American Real Estate Association area, which was started a couple years ago in the wake of one of these scandals. This association has now reached 10,000 members, and they have an ambitious goal to get to 100,000 members by the end of next year. This is according to Real Estate News. Quote, 2 years after rising from the flames of the National Association of Realtors sexual harassment scandal, the American Real Estate Association is growing up. The trade group is now 10,000 members strong and expects to have 100,000 members by the end of the year, according to co-founder and Compass agent Jason Haber. It has also recruited corporate sponsors, created a board of directors, and is hiring its first paid staff member. In August 2023, the New York Times published an expose detailing sexual harassment allegations at NAR, and days later, Haber formed the NAR Accountability Project, saying at the time that while he was an unlikely candidate to lead the effort, I've never been afraid to speak up when I see an injustice. Haber encouraged others to join him in demanding reforms from the trade group. I didn't really have much experience with NAR, Haber told Real Estate News. I just thought this was wrong and something should change. He created an online petition calling for the departures of several executives, NAR CEO Bob Goldberg, Chief Legal Officer Katie Johnson, HR Head Donna Gland, and General Counsel Leslie Muchow, as well as independent third-party vetting of sexual harassment claims and the release of former NAR workers from non-disclosure agreements. All except that last demand eventually transpired, but Haber noted that single-party NDAs, those in which only one party is bound to silence, even if the other party chooses to speak publicly, have become illegal in Illinois, where NAR is based, in cases involving harassment, discrimination, or retaliation. Haber praised NAR CEO Nikia Wright for stepping into a very difficult situation and leading a cultural change at the trade group. Obviously, there were issues with sexual harassment before. I think she's done a good job with policy and helping to right the ship there, Haber said. There's a general sense that NAR is listening much more now, he said. Despite NAR's troubled history, the American Real Estate Association isn't trying to take down the association. NAR is a massive organization, Haber said. We're not gunning for them or aiming to be their size. We're aiming to fill a lane that we think we can exist in and coexist peacefully with NAR, unquote. So just full disclosure here, I am not currently a member of the American Real Estate Association. My company is not a member of the American Real Estate Association. I honestly just haven't taken the time to really look into it and see if there's value there and if it's worth joining. We are members of NAR. I'm a member of NAR. My company is a member of NAR. We're members of the state, local, and national level, of course, as you have to be. And we have no plans to leave NAR. Now, part of that is because of the release of liability that was negotiated as part of the settlement, but I do think there is value in NAR. And honestly, the annual cost to be a member is negligible. So I don't really understand why people get all up in arms about this three-way agreement where you have to pay for the state, local, and national dues because, like I've mentioned on the show before, the barrier to entry there is not that high. It is not that big of an expense. To be a member of the state, local, and national association, at least in my area, it's only $575 per year. So not a big expense to be a member of NAR. All right, shifting gears, Mr. Cooper shareholders have voted to approve the Rocket acquisition. This is according to Inman. Quote, mortgage lending giant Rocket Companies is one step closer to acquiring the nation's largest mortgage servicer Wednesday after Mr. Cooper shareholders voted to approve the merger. When the deal closes, Mr. Cooper shareholders will receive 11 shares of Rocket for each of their Mr. Cooper shares, plus a special cash dividend of $2 per share. Under the terms of the merger agreement, Mr. Cooper shareholders will own about 25% of the combined company, and Mr. Cooper Chair and CEO Jay Bray will become President and CEO of Rocket Mortgage. Rocket, the parent company of Rocket Mortgage, Redfin, and personal finance app Rocket Money, hopes the $9.4 billion deal will help it regain its title as the nation's leading mortgage lender, snatched away by rival United Wholesale Mortgage in 2022. So I can't remember if we talked about this last week or if it's been maybe 2 or 3 weeks ago at this point, but Rocket Mortgage actually fairly consistently has very high customer satisfaction scores through J.D. Power, while Mr. Cooper, on the other hand, tends to not have very good customer satisfaction ratings. So while the acquisition here is going to help Rocket get a bunch of additional customers, they're not necessarily getting a bunch of happy customers. So it'll be interesting to see what Rocket does to bridge that gap, maybe take some of what they're doing over at Rocket Mortgage and implement it at Mr. Cooper to provide better service and make their customers happier. All right, so last but not least, I want to wrap up with a story about the DOJ opening a criminal investigation into Lisa Cook, Fed governor. This is according to RIS Media. Quote, the Department of Justice, DOJ, has opened a criminal investigation into Federal Reserve Board Governor Lisa Cook for alleged mortgage fraud. President Donald Trump moved to fire Cook from her position on the Fed in August, but she has refused to accept the firing, filing a lawsuit claiming the attempted move is unlawful and saying she intends to serve her full term on the Fed until 2038. The DOJ investigation has, per the Wall Street Journal, issued subpoenas in investigation of Cook. The crux of the investigation and alleged fraud is a letter from the Federal Housing Finance Agency Director Bill Pulte addressed to Attorney General Pam Bondi. Pulte claimed that Cook misrepresented her primary residence simultaneously, claiming 2 properties in Atlanta, Georgia, and Ann Arbor, Michigan, as said primary residence on mortgage documents for those respective homes in order to receive lower mortgage rates. Pulte further claimed that Cook misrepresented a Cambridge, Massachusetts property as a second home when she was drawing rental income from it. The Wall Street Journal report noted that proof for intent of mortgage fraud typically requires more than just misstatements on documents. Trump and Pulte both cite that the president has the authority to remove a Fed board member for just cause under existing law. That this qualifies for that standard has been disputed by Cook and her lawyer, Abby David Lowell. Lowell described the attempted firing as an illegal action in a statement to the New York Times. The DOJ has previously opened mortgage fraud investigations into other Trump political opponents, such as New York Attorney General Letitia James and California Senator Adam Schiff. Trump's attempts to remove Cook have raised concerns about continued independence of the Federal Reserve. Trump has repeatedly pushed the Fed, particularly Chairman Jerome Powell, to cut interest rates, including personal attacks on social media. Cook was nominated to the Fed Board of Governors by President Joe Biden in 2022. If she is removed from the position, a majority of the board would be Trump appointees, as the president himself noted to reporters back in August, unquote. All right, y'all, that's a wrap for the show today. Just a reminder, you can find the show notes at realestatebackstage.com/episode 38. And I'll see you here next week with another behind-the-scenes look at the real estate industry here on Real Estate Backstage.